turn now to the focus of the Fed here. Our next guest saying that it's actually the central bank's inflation battle now falls in their hands. Joining us now, we want to bring in Brian Jacobsen. He's Annex Wealth Management Chief Economist and Strategist. Let's talk about exactly what that means here for the inflation battle falling into the Fed's hands. When you see an average hourly earnings print like this coming in slightly higher than expected, we have inflation remaining very sticky. What should the Fed do at this point?
Yeah, thanks for having me. So here at Annex on our investment committee, when we were looking at this morning's report just a little bit ago, it really is one of these things where it's not necessarily a Goldilocks report. It's more like a little engine that could report. As far as just the economy, it just keeps moving along, keeps climbing that hill, that wall of worry. And now it's really up to the Fed as to what are they going to do with this data. They have no idea where they actually want to end up with the federal funds rate. And so they don't know the destination, but they do know that the journey to get there includes more cuts. How many more and over what time frame? It's quite likely that they're going to cut in December at the next meeting, but then shift to a cadence of every other meeting in 2025 because they want to tread a little carefully here. They don't necessarily know how the economy is going to react with the cumulative effects of the rate hikes that they had. Even though they're cutting, they haven't really cut a lot. So I think that really they made a lot of mistakes along the way, but thankfully, American consumers and American businesses have really just kept chugging along ahead to make up for those mistakes.
I want to zero in on the consumer with you for a second because we're seeing small caps rallying this morning, beating out the moves that we're seeing in large caps. And I wonder if that's the market telling us that there's this bet on increased consumer spending that's going to fuel some more growth in those smaller and mid-sized businesses. If we do see that increased consumer spending, though, doesn't that tick up inflation and therefore lead to a Fed that has to be more hawkish? What does that look like to you?
Yeah, quite possibly. I think that the immediate reaction here that we're seeing is that with lower yields, a lot of those smaller cap companies, they have higher debt burdens than the larger companies. And so you can get a little bit more of that relief. So if this almost locks the Fed into continuing along that path of gradual rate cuts, that should provide some relief to small caps. The burst that we could get with consumer spending, if we get a little bit more optimism now that we have the election behind us, and granted, we've traded election uncertainty for policy uncertainty, but consumers seem to be at least saying they're feeling a little bit better. So if we see some acceleration of consumer spending, that should hopefully redound to the benefit of small caps. So we have an overweight to small and mid cap stocks for that reason, because we do think that it's not necessarily going to reverse course for the Fed, that we can see that improvement in consumer spending, but they're still so price conscious that they are very quick to shift to other retailers and other suppliers if they see prices moving higher than their wages are.
So then, Brian, when you take a look at a print like this, when you take a look at the expectations going into 2025, I think many investors are out there asking themselves whether or not this rally that we have seen, whether or not it has room to run, whether or not it can be sustained. When you take a look at a print like this, is that enough to continue this risk-on move to the upside?
I think for now, right, as far as do we then get some sort of pullback maybe in January as people reassess where are they with their portfolios? Sometimes if you think about, all right, if you had something that you bought at the beginning of January, now you get a year in, it's a long-term capital gain instead of short-term. So you can get some of that volatility, I think, as we get into the new year. And a big question in my mind is the sequencing of threats and policies from Trump. When in his first administration, he threatened tariffs and then implemented them when he wasn't getting his way. Now, is he going to come out instead and impose the tariffs and then promise to remove them if he does get his way? So I think that if we do a Trump who is a little bit more coming out of the gates swinging with actually imposing the tariffs, that could come as a bit of a shock, because I believe most people are thinking that you should take him seriously, but not literally. Well, at this point, where we are with valuations and the market run, I'd say maybe start taking them a little bit more literally.
So then what do you do with that, particularly given that you've got a Fed that is going to be cutting, at least if you look at what the market is telling us, but we have long and variable lags from those cuts, and also that policy is going to take time to actually get implemented. Which of those two is going to win out as the driver of the markets, the fiscal or the monetary policy?
I think that for 2025, it's really going to be uncertainty around fiscal policy because they are likely going to take a good chunk of the year trying to figure out that budget reconciliation process as far as, all the horse trading that takes place in order to extend ultimately the Tax Cuts and Jobs Act, but what else gets thrown in there and modified perhaps. So I don't think the fiscal picture is going to become very clear. What is going to be clear, I think, is more the monetary policy side, continued gradual cuts. And so if the monetary policy, the cutting of rates really trumps the fiscal policy side, that should serve as a fairly favorable backdrop for risk assets, but it's not going to be without its risks along the way.
All right, Brian Jacobsen, thank you so much for joining us. We appreciate it.
Thank you.